Welcome back. I'm Mr. Rankin. Today we're going to talk about Chapter 16 in our Business 125 course, Retirement Planning. Some of the learning objectives on this short video: understanding the changing nature of retirement planning, how to contribute to tax-favored retirement plans, and how to put together a retirement plan. So again, this is no substitute for reading the book, but we'll go through these fairly quickly. First of all, let's talk about some of the sources of where you'll get retirement money when you stop working. First source will be Social Security, which is a government-paid retirement plan where you get full benefits. Currently, it's at age 67. That will probably change over your lifetime. You can get early benefits at 62. The formula is set up to get roughly 42% of your earnings. Now, each year, Social Security will send you a statement with the estimated amount that they'll pay you, so this is fairly easy to estimate. The other thing that's a reminder is Social Security also comes with a disability and survivor insurance. These tend not to be large or replace life insurance, but that's an aspect for you to be aware of. The second source of your funds in retirement is employer-funded pensions. Several employees have pension plans. Obviously, the benefits vary greatly from company to company. They're usually based on years of service and what your income level is. The other thing I caution you is because these are both forward-looking, they can change very, very quickly at the whim. All that has to happen is a board of directors of a company change the pension plan and it's changed, or the government vote to change Social Security and it's changed. So even though the current laws are in place, it's a very volatile and changing area potentially, because you're talking about the future, and B, all it takes is a decision to change it and it'll be changed. So the third leg or stool is what's going to come from your personal savings account. Most folks will want to put that in a government tax-incented retirement plan like an IRA or 401k, but think about it as three sources. There's Social Security, there's employee and pension funding, and there's your savings. So, how are you going to plan for retirement? Well, first of all, you need to take a rough estimate of how much you'll need, and there's some tools, and I provided one in some of our links and some of our discussion boards where you can go calculate the estimated amount you'll need. Remember, it'll always be kind of a rough guess, though, because inflation is a guess, your rate of return is a guess. But anyways, you come up with approximately how much you think you'll need. Now, some of that money will come from Social Security, some of it will come from pension, so you can calculate how much needs to come from your savings. Now, as a rule of thumb, because it's so volatile estimating all of this, a rule of thumb a lot of people use is to try to set aside 15% of your income, after-tax income, for retirement. If you can do 10, 10's good, 15's better. Let's talk about some retirement investment options. Now, because the government encourages you to save for retirement, they have the main benefit is what's called tax deferred. You don't pay the taxes until later. So, first investment I think everyone would recommend is if your employee puts in a matched 401k, and what a matched 401k is, if I put in $1, they'll put in 50 cents, or some are as rich as if I put in $1, they'll put in $1. So the match is like a bonus, so you want to take advantage of that first on your list. Second of all is IRAs, individual retirement accounts. For most people, that'll be a Roth IRA. And finally, keep in mind that tax deferred is great, but remember the government is going to put a big penalty on that if you have an early withdrawal. So you got to make sure anything you put into retirement plans is funds you won't be needing. That covers Chapter 16. Any questions? Let me know. Have a good week.